Yeah, no, the dots are very important because it's kind of forward guidance. It tells us what the Fed's thinking. And so right now, if you look at where we're in the last dot plot, which was in March, that was between 175 and 2. I mean, we think, the median dot, if you will, we think it's going to end up somewhere between 325 and 350. And if that's right, that implies another 175 basis points from here spread out over 4 meetings. So that'll be very, very key for our view on where the Fed is going forward.
Yeah, so do you think, where are they going? We've talked a lot about how fast they're going to get there, but where are they going? You think they're going to 4%?
I think you could definitely see 4%. Now, does it happen this year? I don't think it does. I mean, I think you're going to see a 4% sort of number early, say, next year. But it'll, again, if right now the market is priced for, say, 375 at the end of the year, and if the median dot goes to 4, and again, that's not our expectation, but if it were to go to 4, I think that would be a very, very hawkish signal.
Well, our last guest said he would actually, and he's a longtime investor, said he would prefer the Fed to do more on the balance sheet or quantitative tightening side than on interest rate hikes. What would you prefer to see, and what do you think are the trade-offs between each of those tools?
So the problem with the balance sheet is the effects there just aren't as well understood as with rate hikes. We have a long period of rate hikes and rate cuts. We can kind of, quantify how much effect that has on the economy. With the balance sheet, it's a little bit more unknown. And so could we see a balance sheet, runoff today or increase in a runoff today? Yeah. I don't think that's likely because the Fed, the last meeting said, here's our plan. We're going to stick to this plan. And so I don't think they're going to really surprise the market with, raising the runoff in the balance sheet. But during the press conference today, Chair Powell potentially could allude to that if a question comes up about that.
There was recent research that said about $2 trillion of balance sheet tightening over 3 years would be equivalent of anywhere from about a 0.3 to a 0.9% rate hike. In other words, it's not that much. Do you think that's broadly right, that, it doesn't pack as much of an interest rate punch, or could it? I mean, again, these things we've only been through this once before, and that one ended with the repo crisis.
Right. And so, again, if you think about that range there, 0.3 to 0.9, I mean, yeah, Kelly, you're right. In some sense, it's not all that much, but that's a pretty big range, when you think about it. And already there's been a significant amount of tightening in financial markets. Credit spreads have widened pretty dramatically. The stock market or most major stock indices are in bear market territory. The dollar has strengthened. These are all signs of financial tightening already. And so if you throw on top of that, an acceleration of the shrinkage of the balance sheet, you can have a lot of tightening coming at you whose effects aren't all that well known, and there could be long variable lags in there as well.
Is there any reason for the Fed to go slowly as it raises from the current 0.75 to almost 1% range, which we can all acknowledge is too low for this economy, to something upwards of maybe 3%, maybe 4%? I mean, what is the case for doing it 50 versus 75 versus 100 basis points at a time?
Well, so I think the case is the way the Fed thinks about it is the so-called neutral Fed funds rate. So they want to clearly get to neutral, and probably they need to get into a little bit of a restricted territory right now. And so some folks would say, and I think I largely agree with this, the faster you get back to neutral, the more you slow the economy, the more you can potentially take some inflationary impulses out of the economy. If you really delay here and you continue to overstimulate the economy, you're going to end up with an even higher inflation rate. We're going to end up looking like the 1970s again. And the way the 1970s ended was with a significant tightening in the early 1980s that put us in a very, very deep recession. So if you can get out in front of it right now, if you do go into recession, knock on wood, hopefully the recession isn't as deep as if you have to do a lot of tightening, significantly more tightening later on.
Almost sounds like Jeff Gundlach. He said they should raise it to 3% today.
Well, I think that's all due respect to Mr. Gundlach. I mean, I don't think that's not going to happen today, and I don't know if you necessarily want to go that fast. But 75 sounds like the right clip right now, and I think it'll be interesting to see if they're talking about already in the press conference if they're talking of potentially another 75 in July.
What is most important to listen for from the Fed chair as he begins his presser?
Well, so remember, when he's talking to the press, he'll be speaking on behalf of the committee, not just for himself right there. And so if he comes out talking really hawkish, then that tells you that the consensus on the committee right now is to continue to be hawkish, to continue to raise at an aggressive sort of pace. So the more hawkish language he uses tells me that's where the other FOMC members are right now.
And real quickly, but is there any, I mean, do they need the unemployment rate to go higher from here, basically, in order to slow the labor market down enough to really get a handle on inflation?
Yeah, and so that's the trick. How much higher does the unemployment rate have to go from here? I mean, if it shoots up significantly higher, then you're in a recession. But it probably does need to go a little bit higher here to take some of those wage gains or to decelerate some of the wage gains that we've seen recently.
All right, Jay. With 13 minutes to go, we thank you for your time. We'll let you go. Jay Bryson of Wells Fargo.